Trading is accessible to anybody that has internet, a few bucks, and a computer, and it's available anytime during the day. And I think that's one thing that lures people to trading for a living, because the schedule can be whatever you choose it to be. So once people put together a trading plan and they backtest their trading strategy, they're ready to commit real money to replace their demo account. And their trading strategy can be based on whatever you choose. And if price patterns is something that interests you, I have a free manual on trading certain patterns that actually have an edge in the market. And you can download it through the link that's up here in the right corner or from the description below. I think you'll enjoy that. And moving on to real money, it's a rite of passage for traders, as they've done everything that has been suggested. They found and they tested a trading strategy that meets their goals and their level of understanding. This strategy has been tested. All trades were logged. So metrics such as maximum adverse excursion can be examined. And they begin to follow the trading plan that includes the types of setups, the stops, the targets, as well as whatever the overall risk exposure they'll allow for the trading account. And full of excitement and discipline that something new can really bring, they do well in following the trading plan and are having some success. And as traders cruise by every single week following their plan, once in a while, whether it's fear, greed, or overconfidence, they hit a stumbling block. And this block, if it's not quickly dealt with, can cause everything to tumble. Some days people think the market's going to be a gift that keeps on giving. So they jump back into the market and they promptly turn a winning day into a losing day. Is it fear that causes this stumble? The fear of missing out? On a great day where the market just wants to pay you, those that overtrade are afraid of missing that big move. And when the fear of missing out hits you in trading, that is a warning sign that you have put too much importance on an individual trade. And that's an issue, because from there, traders start to tweak their trading rules because of something that happened in one trade. Now, a trade by itself is not important. Trades, plural, are what matters. Remember that your wins and your losses are going to come at a random distribution. So is your next trade going to win or lose? Who knows? Who cares? Because if you're using a method with a positive expectancy, you have to let it play out. And for day traders at Netpicks, we ingrain in them that the power of quitting at specified times during the trading day is important. And we use terms like one and done, or one trade and a positive result on the day. The first you can understand, but the second is simple as well. You take a trade. If it wins, you stop trading. We'll also use time stops, such as the only trade the first 90 minutes of the day. And for a lot of people, that takes a healthy spoonful of discipline, but our stats show that following the POQ, which is the power of quitting, can actually have a positive impact on your trading career. So if you don't have this aspect in your trading plan, I suggest that it's something that you test out and perhaps implement. And it can be tough, but at those times, you have to shut down the computer and walk away. Now, trading, it's not a team sport. So unless you're trading in a firm, you're going to wear all the hats in the business. You're the accountant, you're the trader, the researcher, the risk manager, tech support. And they're all important, but one stands out for me, and that is risk manager. The risk manager ensures that I keep within the risk parameters and the position sizing that's dictated by my account, the trade setup, and the plan. So I answer to him, and it is that role that prevents me from just jumping into trades. But I failed this role back in 2008, and I was in a forex swing trade, and I moved my stop loss. But I moved my stop away from price, which increased my risk. The trade lost, and the initial 1.5% risk profile ended in double digits. I believe, if memory serves me right, it was about 12% of my trading account that took a hit. And there are several risks in trading, of course, but when I say risk manager and management, I refer to the risk manager watching the trade and the overall portfolio exposure. Ensures that the stops are moved when appropriate, as well as scaling out when needed. So if I'm in a trade that's firing with momentum and it's going in my favor, the risk manager steps in, reminds me that momentum thrusts can actually equal mean reversion. So it ensures that I scale out and I adjust my risk. The trader in me wants full position wins, especially when the market's moving. But the risk manager ensures that I give very little back and I take profits when they're needed. And I covered this in a recent video about sugar in a trade that I took. And you could check it out here because I put the video up on the right. And when I wear the hat of a risk manager, I look at things only from the perspective of risk, protecting my capital and the profits that are appearing in a trade. It doesn't stop me from taking trades according to the trading plan, but it ensures that the risk percentage fits my plan. And I'm going to say that over the years, I've done a lot better job of wearing the different hats, but it's hard. Sometimes having someone to be accountable to would maybe make things a little bit easier. But who knows trading and yourself better than you? Yeah, there are trading groups, there's trading forums, there's mentors, and they all can help. But if anything, I would just enlist a professional in the psychological field. Trading, it brings forth primal tendencies, and we've all felt it. It's that flush of anger when we get stopped out of a perfectly acceptable trade. It's that excitement of banking a 10R trade and seeing your account size grow. It's the hesitation in pulling the trigger on a legitimate trade because the last 3 trades lost. Believe that if trading does not work out, many people look at it as a personal failure and they get scarred. And there are trading books like Trading in the Zone and anything by Tharp that can help deal with it, but I would prefer an actual person. But trading psychology, it's not the most important thing in trading. Well, it makes up what we call the 3 legs of trading: the system, the mindset, and the risk. Without a sound trading strategy, think of the Darvis box strategy, for example. It's pretty meaningless. If you could put it in a hierarchy, focus on getting your trading strategy and then run full steam into the psychology of trading topics. But you need a positive expectancy system first. The mental side comes after. So that quotes about being 80% mental often refer to the elite level, not the neophyte to something, not the people are just starting out. And as you mature as a trader, you actually begin to work both sides of the equation.